Good day and good morning, everybody. Trevor Hall here with Mining Stock Daily. Welcome in to this week's long form episode, and it's a good one because we have the Shrub. He's back on the MSD airwaves because we've got a lot of things to talk about. And it kind of takes a little bit of a turn. We talk a lot about China and what the Chinese demand of commodities means as their economy is really flailing and their stock market is really struggling. So that takes up a lot of the conversation. But then we talk about a little bit of, is it anecdotal? Some of the banking issues that came forth in the U.S. market this week as well. It's just a big conversation with the Shrub, and it's also, might I dare say, a little bit entertaining as well. So thanks so much for his time. And special thank you to Fireweed Metals, Arizona Sonoran Copper, Vizsla Silver, and Victoria Gold for their support of the podcast. And my ask to you, the listener, if you wouldn't mind, please leave a review, press that like, subscribe if you haven't done so. It's all constructive for us to get as much feedback as we can. All right. I hope everybody has a wonderful weekend. Here is the conversation with the Shrub. All right, everybody, welcome into this week's long form episode on Mining Stock Daily, and it's going to be a special one because we haven't had this guest on in I think over a year. I think his last time Le Shrub was on was our final episode of 2022, and his opinions haven't stopped. He's still active on Twitter, sharing great ideas and commentary on what's happening in markets and other events around the world. But if we just haven't been able to get him on this podcast for some time, so it's a real pleasure of mine to welcome Le Shrub back into Mining Stock Daily. Hello, buddy.
Trevor, it's so good to be back. So good to be back.
Never
a dull moment in the space.
No, I don't even know actually where to begin. I mean, you just communicated to me. We're recording this Thursday late morning my time, late afternoon, early evening your time. There's been a ceasefire announced in Gaza.
Well, that's what the headlines were saying. Yeah, the Gaza negotiations are advancing. So. Anyway, that took oil down a bit, but as I said, gold is holding up, which is quite surprising. You can thank Yellen for that, though, but we can talk about that later.
Okay, we will table that because there's a lot to get through. Shrub, let's just maybe that news has just hit the tape, so I'm not even prepared to talk about that, but maybe that will come up in conversation throughout. But I do want to talk about yesterday's Fed announcement, or I don't know, kind of lack thereof. And we had this discussion with multiple people all of 2024 here, all of January, about it seemed like the market expectations were way out over their skis. We talked to Brent Johnson about that, back in VRIC. And also, there's this huge spread between market expectations of rate cuts in 2024, that Fed dot plot. Jerome Powell comes out there yesterday and basically says, listen, a March rate cut is not even in the cards here for the FOMC. The market retreats, but here we are the following day, and let's buy tech. The same playbook.
Because it's simple, isn't it? It goes up. If it goes up, just buy it.
Yeah, right?
Look,
hey, how are you watching this? Hey, what you're watching this? Hey, how are you you got to have your head on a swivel like every single day.
Yeah, look, it's quite intense, but I don't know if you're following. I've developed this theory with Tamagotchi Yellen, so we can talk about Tamagotchis if you want and have a little fun with that, which was something I developed as a theory last quarter. So, everyone is focusing on the Fed. Okay, the Fed is going to do 50, the Fed is going to do 100, but they were kind of, and then last quarter, when bonds were selling down to like a 5% yield in the 10-year, and people were worried, there's so much bond issuance and no one's going to buy these bonds, and everything is out of control. And that's when the Treasury has this thing they call the QRA, which is like the quarterly rebalancing. Where basically they announce every quarter how many bonds they're going to issue in the next quarter. And, it's a big number nowadays. It's like $1 trillion, but who cares? So anyway,
The trillion doesn't even matter. A trillion is just a T.
A trillion.
It's just a T, Shrub. Like
A trillion is like 2 Teslas. Anyway, so back in the end of October, you were having these bonds selling down. And that's when Yellen was going to announce, the new QRA. And that's when I kind of realized, I like to visualize things because I'm a very simple person. Like it kind of helps me. So I was thinking, you know what? Yellen's a bit like a Tamagotchi, those Japanese games where you kind of have like you feed them, they're happy, and then you don't feed them, they're unhappy. So you have to think of them like what's the reaction function of a Tamagotchi? Give them food, they're happy. Give them too much food, maybe they're a bit sad. But you have to keep a balance. So what was the reaction function of Yellen? Yields above 5%, bad. I'm going to do something about that. So comes into the QRA. What does she do? She stuffs like everyone with bills. So you have a choice between issuing bills or issuing bonds. If you issue bills, it's stimulative. If you issue bonds, then you're removing liquidity from the market. So what does she do? She issues like 60% in bills. And by the way, the Treasury usually issues like 20% in bills, to give you an idea. So basically, Yellen at that moment was like, you know what? I'm feeling like I'm Evita Peron. I'm going to go full Argentina. I'm going to print 60% bills. And here we go. Like, so lo and behold, like from the lows of October, the market had like a 20% rally. And the bonds went from like a 5% yield to a 4% yield. And that's thanks to Tamagotchi Yellen. It wasn't thanks to Powell. It was thanks to Yellen. So back to my point, like you kind of have to understand how important she is in, and when I say she is, because again, it kind of helps me to visualize this whole thing, right? But the Treasury is very influential now in monetary policy. So it's like she sneaked into the monetary policy because of the way the plumbing works. I mean, if you want, we can go more into that. But come into the December Fed meeting, and obviously Powell flipped as well, and he was dovish. And then we come into the new year, and we start the new year a bit weak. And then what does what's the headline we got in the first week? There was a headline that maybe we should roll back quantitative tightening. We're going to discuss quantitative tightening. So that gives another boost in the market and the economy. And then we come in the new QRA, and it's a nothing done. They're going to borrow another trillion, and they're going to issue like 400 billion of bonds, but who cares? So basically, what I'm trying to say is that we used to care about the Fed, but now we should care about the Fed and the Treasury. They're kind of more intertwined, and the Tamagotchi has sneaked into the monetary policy in a way. And it's going to be very important because, they can kind of like, because we have the mix of bonds versus bills from the Treasury. We have the rates coming from the Fed, and we also have the pace of the quantitative tightening unwind, the tapering of QT. So you have all these things, and that's why people are confused. It's like, people are looking one way, but actually what's happening the other way could be more important. And then to complicate things even more, we had a new mini banking crisis yesterday.
Yes.
to just give like another little boost into demand for bonds. So like a quarter ago, no one wanted bonds at 5%. Now everyone wants bonds at 4%. And I'm telling you, like, I could see a scenario that in 1 year's time, everyone wants bonds at 3%. I wouldn't be surprised. Would you be surprised? I wouldn't be surprised.
Well, I think to this point, I wanted to interject here and kind of follow up and kind of break down this thesis, because a lot of in the fall and into the winter, we were talking about the amount of Treasury supply coming online, and a lot of commentators and analysts were saying, well, talk about the supply. Is it oversupplied? Who's going to actually buy this? And you're watching this, and it's almost as a contrarian thought. Well, most of the market was worried about supply. You're sitting back there and almost realizing that, listen, U.S. debt is still one of the safest assets to buy and hold for anybody. You can talk
100%.
about you can talk about China and other Eastern countries selling their U.S. debt, or but they still own a tremendous amount. But so you're still seeing high demand for this, despite the supply doomsdayers that were out there in the fall.
And it's so simple. Like that's why I like the visualization of Yellen as a Tamagotchi, because she can
Yeah.
get you, if she wants, she can get you to put your whole portfolio in treasuries. You know how she can make you do that? There's so many ways. Like first thing, she can smash the market anytime, and then trust me, you're going to be buying bonds at 3%. She can change the rules and say, you know what, we should allocate, pension funds should allocate this much, banks should allocate this much, and they can do it this way. There's a lot of ways to skin the cat. So this thing about there's no demand for U.S. treasuries, come on, no chance. It would let's not go like completely apocalyptic here that they're going to force you to do it, but there's ways to entice you to do it. Let's not forget there's a lot of liquidity in the world. And another thing about the U.S. treasuries, to keep it extremely simple. So I live in Europe, but imagine someone living so in Europe we have what the German bunds are. Let's see where they are nowadays. So today they are at 2%. So so I have a choice as a European to buy German goods at 2% with a currency that's not that great anyway, Japanese debt at 70 bips, or treasuries at, short term at 5, long term at 4. That's much more interesting. And even about China, that people cry about China's blowing up and China yabida, but China's like 2.8% on the 10-year. I mean, that tells you a lot. Like, would you prefer to buy China at 2.8 with the yuan, or do you want to buy U.S. treasuries at like 4 with the dollar? You're going to buy U.S. all the way.
Well, the
So
strongest currency in the
really
world.
I'm really not worried about this thing about the U.S. debt is, of course, that's unsustainable, dude. I mean, we know it's unsustainable. It's like a simple spreadsheet calculation, but but it's not. But it's the U.S. It's the reserve currency of the world. So I'm really not worried about that.
But the
and if you're worried about that, you buy some gold, and you're kind of hedging the risk the other way. So
right. But that sustainability. I mean, yeah, someday the house of cards is going to come crumbling down, but that's not any time close.
But they can look. That's why I mentioned gold, which, as you know, I hate gold, by the way. I said it in the last program, but actually, but you know what? Since then, I mean, I have to say, I mean, it's the kind of, these are the kind of times where you have to actually not be negative on gold, because if it's unsustainable, trust me, the US is not going to default. What they're going to do is they're going to cap yields one way or another, and that's when gold goes to 3,000. So you're not going to have a default. You're not going to have a loss of capital. You're going to have a loss of purchasing power, which is kind of what we have for the last, I don't know how many decades. So it's just getting worse in terms of quantum and speed. So and also I have this, I have these two notions that I keep in mind that it's worth mentioning. Going back to the reaction function of the Tamagotchi, because this is how the central bank works nowadays. You should distinguish inflation in two ways. You should think of inflation as wealthflation, so how much assets go up, and this is what rich people experience, and that could be the price of houses, luxury items, real estate, private schools. And then on the other side, you have plebflation, which is what the plebs are experiencing, like you and I, to be fair. It's like, the cost of living, the cost of, mortgages. So all these things we have in a daily life. So these are two separate things. So the reaction function of a Tamagotchi central banker like Yellen and Lagarde and the BOJ is basically, as long as plebflation, so what the middle class is feeling is below, call it 2%, we can do whatever we want with liquidity injections and rates. And we don't care if wealthflation increases by 10% a year. So this is what we had until 2021, right? We had like wealthflation was going up. Luxury goods were going through the roof. Housing was going through the roof. London prime real estate, New York prime real estate, but actually everything else was like kind of more modest. And suddenly it was at 2021, the COVID and Ukraine creating these bottlenecks that caused plebflation to go above 10%. And that's when the central bankers were like, shit, our reaction function as Tamagotchis, we're kind of, it triggers, okay, plebflation above, say, 4 or 5%, well, we have to act. And that's why they got so tight. But now that we're trending down towards, back to 2-3% on the plebflation side, because we're seeing supply chains coming, easing even with the Red Sea and all that nonsense. We have agricultural prices, food prices coming down. So plebflation is coming down. So that's why they feel more comfortable on the wealthflation side. And they let NVIDIA trade at $2 trillion and Apple at $3 trillion and NASDAQ being up 50% and not caring about it. Because I see one big mistake that people make in this market is they're saying, oh my God, NASDAQ is up 50%. How is the Fed going to cut rates? It doesn't matter because it's two separate things. NASDAQ going up 50% is wealthflation. Core inflation, which I call plebflation because I like it and I can do what, I'm still a parody account on Twitter, so I can call it like that. Plebflation is low, so they're going to cut rates. They don't care where the NASDAQ is as long as their core inflation trends down towards 2%. And that's why it was like a very Goldilocks type market. Which brings us down to our stuff as well, like the commodity side of stuff. We, as I'm a tourist commodity investor, so I'm like a complete tourist in the space. But you see the mining companies are, commodity prices are modest. They're kind of cool. Everything feels a bit deflationary, and everyone is chasing tech. That exactly portrays what I'm saying about plebflation versus wealthflation. NVIDIA up is wealthflation. Glencore flat, Anglo down, that's plebflation because that's the stuff we use in our daily lives. By the way, if we want to make it more interesting, as you keep that easing going, of course, that liquidity eventually is going to feed into the real economy, and we're going to go back to square one, which is the 70s scenario. So, everyone shows that chart in the 70s. Yeah, go ahead.
Okay, so talked about that 70s. So are you referring back to the next wave of inflation?
Yeah, the second wave of inflation. Yeah, the second wave of inflation, which is quite possible. I actually like to warn people not to get ahead of themselves. But that's why I think, commodities in some way should be a core part of the portfolio. But the percentage that you allocate to it should vary. So, for example, I think we're kind of like, in the 70s, we had the first wave of inflation, things eased, and then we had the second wave of inflation, and then that's when Burns became a martyr, and they had to bring in Volcker to fix things and jack up rates to the moon. So people always make that analogy. It's like we had the first wave of inflation with the Ukraine war. Now we're having a lull and we're about to have a second wave of inflation. I actually don't agree with that. I think the first wave of inflation we had were two extraordinary events. So we had Ukraine and COVID. So that was extraordinary. We can be sitting here for 1 or 2 years with inflation trending down. But if we keep this liquidity going, fast forward in 25, then that money is going to move into commodities eventually. And that's when we could have a second wave of, I'm going to call it again, plebflation. And that's why I think that's when you start allocating, if I'm like 10% in commodities right now, that's when I should be like almost all in commodities, because that's when Yeah. And also, if I can just make one more point, which is very, very important, the way it becomes reflexive in a way. How does it become reflexive? It becomes reflexive because it's reinforcing in a way. It's reinforcing in what way? Today, we're sitting here and we're saying, okay, China is blowing up, and core inflation is easing, and copper, who cares about copper? And then people always forget how long it takes. So imagine if we fast forward in 2 years' time and we're actually accelerating again, and we actually do try to build all those green energy projects and rebuild the US grid, and we're like, oh crap, where's the copper? So that's why it becomes reinforcing, because I have this notion that you know by now that I think the financial system and probably the whole system is run by monkeys, and we are monkeys participating in it, in the sense that we don't, people are not serious. They don't act unless it's urgent. So are they going to be urgent about the copper deficit that's projected 5 years out? Of course not. They're going to become urgent about it in 5 years' time. And then what's the price of copper in 5 years' time? Who knows, right? So it becomes reinforcing because people are focused on the today, and on the today, there is no copper. We have actually a small copper surplus this quarter. But even, just sticking with copper as an example, you see obvious things, like you had the Cobre Panama, which is 1.5% of the world's copper supply, getting offline. Then you had Anglo American having a disastrous copper guidance downgrade. And then even today, today you had Glencore showing their production numbers, and they're down 5%. And they're
substantial.
Yeah, it's down 5%. So you're like, these are the good guys, and the good guys can't keep up with their copper output. So how are we going to solve this 2 years out? And the funny part is, copper could do nothing this year. But if it does nothing, no one's urgent about it. You know what I mean? So that's what I'm trying. Yeah. That's how you get to a second wave of inflation without doing anything, because you're sitting here and you're doing nothing. And actually, let me bring you to my favorite commodity, which is tin, which is how we have to talk about tin, right? I mean,
tin barons, ears perked up, right?
Tin barons, exactly. Yeah, getting excited. But you look at tin. Let me just get that. I was looking at the production numbers. So listen to this. Mine production 2023, 2022, 307,000. And then 2023, 290,000. So Indonesia went down from 70 to 52, and Peru went from 28 to 23. And that's like, with everyone getting excited about AI, you're like, why doesn't anyone care about tin? Why isn't like a critical metals on the critical metals list for every country to just stock up on tin? Because you remember, I mean, the US had it as a critical metal, and they always had a stockpile. So simple things, but no one cares about these things. And
if the AI generation is going to boost productivity at some point and really spur the next level of economic growth, which a lot of people are projecting, it's going to take, I mean, tin is just one of many, right? It's going to take a lot of computer power to get that going. And obviously you need to supply that computer power with the raw materials. I mean, and tin is a huge one. Copper, obviously, a lot. I mean, there's a lot of talk about the likes of manganese, rare earths, where they're coming from. I mean, will we just kind of forget that we're shuttering that we're supposed to be kind of in this Cold War with China and resupplying or nearshoring our own supply chains while this is happening, in hopes that we can supply that for our own manufacturing down the world? Or will there become a time where like demand is just so high, it's like, sorry, China, we're going to need you no matter at what costs?
Absolutely. And then speaking of which, by the way, the other thing that people always forget about, so people are talking about the Taiwan-China war possibility.
Right.
Well, we were talking about copper. where is 70% of copper being processed?
In
It's
China.
in China. So basically, we always forget, oh, China is short of commodities. It's like, no, dude, China like refines most of the world's commodities. So,
Right.
so basically, we have that parameter as well that people really don't take into account. Which me as a tourist, thankfully, I figured out that you kind of it's the mine, but it's also the refining and treatment of a lot of these metals that we're ignoring.
Yeah.
And I don't know if we're not doing enough about this, and it will become concerning. I mean, and even in the case of tin, it's a very simple example because you look at the listed companies and you're like, wow, I mean, there's no way you can't even invest in the bloody thing.
Right.
There's two listed companies and there's no ETF, and well, there's pretty much that's why no one cares about it almost.
Right. Well, and on the copper side, and I tweeted this morning actually about kind of my thoughts with copper. I'm looking at that copper chart, and I've got this long-term trend, and today copper fell back below that trend, and I just really never trusted this move higher. What as it moved closer to $4 a pound? It's like 385 now. I just keep on thinking, listen, like China obviously has its own problems, economic problems. It's not growing. It's trying its best efforts trying to stimulate its economy and absolutely falling face down first every time it's done tried to do it in the last few months. So it's not working in China. The United States is trying to get back on its feet with its manufacturing, but still, relatively slow. The world economy is just slowing down. Europe's basically in a recession, arguably. Germany, the biggest manufacturer in Europe, has been in a recession. I just do not understand where the demand for copper would be at this current situation that would move it sustainably above $4 a pound. I just don't see it. Now, long term, I think you're right. I think we could have pretty similar moves in copper that we've seen in uranium, because uranium was backed on a fundamental supply deficit. When you have
Exactly.
producers buying on the spot market to meet its obligations, you have a huge supply problem. I think we could see that eventually in copper. I just do not see it now until we get some sort of green light. Stimulus is working, global economic growth is back in front of us, and it's full sails ahead. I just don't see it, and I guess that's not a
I
question.
agree
That's just
100%. Yeah, no, I agree 100%, and that's why I'm a proponent of having your sizing correct, because right now things are not looking good, and that's
right.
exactly why we have to differentiate from I'm a trader. I'm not. I don't pretend to be even a long-term investor. But imagine, like, let's think about this from the perspective of a trader. I don't need to own copper right now because I think Q1 there's a little bit of surplus. There's nothing going on, and also I think that China launched some few hundred billion of projects for the year, but a few hundred billion of projects, it's kind of like what Yellen prints in a quarter. So it's like the scale is is kind of like different. So so those projects are probably going to be like second half weighted, which means H1 could be kind of weakish, huh, from a demand
Mm-hmm.
perspective. So you don't need to own it at this point, but that means, and that's why what I'm saying is, you don't want to have all in. You don't want to be all in commodities now. You want to have some, but you don't want to be too much, because you could be seeing that weakness into 2025 even. Because
Mm-hmm.
that's why I mean, like, there's a lot of people on Twitter, especially, they get excited about this second wave of inflation. But in reality, on that chart in the 70s, that even lasted 2 years. That gap from the first wave to the second wave is 2 years. So we could be waiting like 2 years before we get that deficit building up in something like copper. I mean, remember, uranium was the same, huh? You like uranium, I kind of gave up on it on 2021. I think that was done. And then it came like roaring back because of the physical deficit building up. So it's going to be the same. I mean, even something like tin, which, it's a very small metal, and that's not even doing much, even though there's a deficit. Because, things need to clear up, especially when you have a weaker economy. There's always like a few tons of copper lying around, or, especially in the case of copper, Chinese construction is such a large part. So even if 50% of copper demand comes from China, you can expect, you could have like a sluggish copper market for 2 years. But what does that mean, though? That means that if you don't invest today, you're going to have a massive spike in 5 years or 3 years. That's what I'm trying to get to. How you actually get the second wave of inflation is when you come to, because today you should be acting for 5 years' time, but we're not really seeing that. And, we're not seeing that coming in, apart from some projects in, Latin America. And, anecdotally, I was looking at Anglo-Americans' woes, for example. And what's surprising is that, Anglo-American, because they did so well buying iron ore in 2007, right? Remember how well they did out of that iron ore purchase in Brazil? It was a complete disaster for them. So they thought, oh, it's a good idea to diversify as well into fertilizers. So they bought that UK project to spend money on that. So, a company like Anglo that has like pretty decent copper assets, they decide to just chase the next hot thing and spend $9 billion in some fertilizer plant, which is actually, let me just make a side note on this one, because I want to bash a little bit Anglo here. So Anglo, as you know, they control, there's a monopoly in platinum. Right. So it's 4 players pretty much. And they couldn't make money for the last 2 decades running a monopoly in precious metals. So now they want to enter fertilizers, which is a monopoly, it's an oligopoly between Canada and the Eastern Europeans. And they want to get in, and they think they're going to make money out of it. I mean, seriously, Anglo-American, how low have you dropped from the times of the Great British Empire? Seriously. Shut it down, take that money, just build some new copper mines, crying out loud. Anyway, but, see, that's the problem. I mean, you have these big mining companies doing stupid stuff like that. So, people have to get serious. Which, for traders, it gives opportunities, because, we can find ways to make money out of it.
Yeah. From those highs, those inflationary highs where copper popped up just over $5 a pound, that was, let's see. So it was winter 2022, right? So inflation's running super hot. The Fed finally gets off their ass and decides they need to do something about it, because it's not going to be transitory if they don't, and they start that rate hiking cycle that just really crushed almost everything in its path, 2022, including copper. I mean, I do think where copper is sitting right now is actually pretty healthy. It could have been a lot worse after all those rate hikes, but I do think that I'm with you. I think if and when that second wave of inflation happens, and you think 2025 potentially, I think that $5 copper is going to sound like peanuts compared to where it will be. Not only you'll get the speculative trade, but you'll get that stimulus trade as well.
Exactly, yeah. And also, we kind of figured out that, we live in a high deficit world. So I think the big difference between what we were experiencing 10 years ago with monetary policy versus now we have like the biggest fiscal deficits. We went crazy at COVID, but we kept staying crazy. And actually, even the US has massive infrastructure needs that they should be addressing. Mm-hmm. So it's not just China. So, it's the question that everyone should be asking with commodities is which we discussed together, is, can you have a commodity bull market without China?
Yeah, the answer is, you and I have talked about that.
Yeah. So that's the key question for me. The very, if you want to address it from a first principle perspective, you start with a very simple uh, analysis, and you just say, okay, which commodities, what percentage of each commodity does China consume? And then you start going down the list, and you're like, oh, iron ore, it's 50%. So, okay, iron ore is probably not a good, hold. It's not a good long at this point. And then you say copper. Okay, well, that's not a good one either. But then you say, okay, but copper, you're going to use it for electric vehicles and and green energy, yabida. So that kind of like one offsets the other. And as you've said, we've had a pretty bad year in terms of economic performance in China, and copper is still up here. So that's, something must have happened somewhere, right? And I think that something is probably a shift that's going in China in terms of electrification and EVs. It's helping out.
Right.
Otherwise, we wouldn't be trading up here.
Well, and to piggyback on that thought, Shrub, I mean, we talk about that question. I mean, do you need Chinese infrastructure build to really boost the next commodity cycle or super cycle that people always are speculating? But I think what a lot of people are missing, like, it doesn't have to be just physical infrastructure. And this idea that I'm about to say actually came from listening to our mutual friend Dmitry Kafinas on one of his latest Hidden Forces podcasts about China. And his guest was talking about digital infrastructure and how China is absolutely crushing everything in its path in the development of its digital infrastructure. So when we talk about infrastructure within a commodities cycle or super cycle, I think it's important. You have to connect those two. There's the physical infrastructure, the things we use and drive on, and it allows us to, do our things every day. And then there's the digital infrastructure that there's no end in sight. That will continue to develop and build throughout our entire lives until they shut off the electricity. And so you talk about physical infrastructure, digital infrastructure. I think China continues to be that digital infrastructure giant, but at the top of that, you will also have a Western physical and digital infrastructure stimulus at the same time here in our lifetime. I think that happens, and those two combined. I mean, fuck, man. You talk about deficits. It's gonna be wild.
Absolutely, and and that's why there's two sides to the equation, right? Is the supply and the demand, and the demand can go stratospheric at some point, and the supply is not moving. So you just got to pick the spots and see which one is the next uranium.
Yeah, right. You've been following that uranium trade, huh? It's kind of crazy.
Yeah, it's
Have you
kind of
dabbled? Have
annoyed.
you?
No, I played it like I played the first wave. I missed the second wave. That's why I don't want to miss any more second waves here.
Fair enough. All right, let's go back. I want to talk about some of the macro news here, and enough about the commodities. I think we've made our point. But I do want to continue with this Chinese talk because there's obviously this Evergrande bankruptcy that's hit the news. Their economy is absolutely flailing. There's a lot of ugly charts out there, but Chinese market charts are just absolutely gross. And so we're just kind of talking about there's little faith in Chinese growth right now. No matter what they do to try to stimulate their economy, it's still falling flat. Manufacturing output has been down for 4 straight months. Will anything work here? Or does this need to just kind of run its natural course?
Yeah, you know what China needs? China needs a Tamagotchi.
Ah!
Because they need someone with a reaction function that says, you know what? I said that, so I was joking that when the Hong Kong index went below 15,000, they came, the prime minister came and he said, we're going to allocate 200 billion to support the stock market, and we're going to do this, and we're going to do that, and we're going to ban short selling. And I was like, you know what? Maybe China just got their Tamagotchi, and his reaction function is basically Hong Kong index, HSI, does not go below 15,000. So, you have to see how they get triggered. And I think that 15,000 was a pretty big level for them to come out. You know what? This is where we draw the line. We can't have our stocks going down like crazy all the time. And I think their problem is they're kind of drip feeding. So they start with like 200 billion to support the market. Stocks go up and then they go down. And then they come up with like, oh, we're going to ban short selling. Stocks go up and then they go down. So I think it's not in their nature to do a Yellen type bazooka, which she does every few weeks nowadays. It's more like we're going to like, sorry, let's put it this way. When Yellen gets in the market goes up 20% in the US. When the Chinese get in the market, they just stop it from dropping another 10%. That's the big difference. That's the big difference between the Western Tamagotchi and the Asian Tamagotchi. So I think what the Chinese are trying to do is they're trying to rebalance their economy, which, by the way, long term, I actually admire. I have to give them credit for something. I admire them for one thing, is that they're doing some things that are very, very good for the long term benefit of their country, whereas we're doing some things that are very bad for the long-term benefit of our country. One very simple example is, they came and regulate the gaming companies, that you can't give rewards. Kids are not allowed to receive rewards or pay for rewards or, spend so much time. I mean, that's good. Like, I wish our governments did that. As a father, I would like them to just limit how much you can spend on games and how much, there's games on the iPad where you have all these ads popping up. I kind of want that regulated.
Or just social media in general.
Social media in general
has been a stupid spectacle at Congress this week. I mean, it's like you try to put the spot on Mark Zuckerberg, and I'm not saying he's a saint and all this, but the thing is like they try to make this spectacle when he's up doing their committee thing, but the Congress and the Senate haven't done a damn thing where they could have regulated social media for the last 10 years. So who's to blame?
Absolutely. And then the other thing that I think could become very important, I was reading there was an article about private tuition in the US. So like wealthy people are paying a lot in private tuition to get their kids in Harvard, and they spend like $100,000 a year for tutors. I mean, China had a private education industry where you were paying money to help you pass exams. Of course, in the US, there's a lot of nepotism because that $100,000 probably just gets you to the back door as well. So, but the Chinese had a system of paying of tutors, and Xi banned it. I mean, he made it non-profit. Good for him. I mean, that's good for the average person. The stocks collapse, but who cares? You're doing something good for your people. Whereas in the US, sometimes Europeans, Europeans were too socialist, but the US sometimes is a bit too capitalist and short term. And that's just bad long term. So I think I want to give them credit where they're doing something that's good in the long term. But if they want to be serious, they should also be building their capital markets, because without capital markets, you're not going to be able to win as a country or even compete as a country. I mean, as an example, I was looking at something interesting that I want to elaborate more at some point in a research note. The amount that Baidu is like their leader in AI, and the amount that Baidu spends on cloud versus the amount that Facebook Meta spends on cloud. I think it's like a scale of like Baidu spends a few billion and Meta spends like factor of 10 on top of that. I haven't looked at it. Actually, Meta spent like 100 billion of capex, I think. So I think when I looked at it last year, Meta spent as much in capex in 1 year as BHP, Rio, Anglo, Glencore together. That's insane.
That is.
And then you have but that's why Zuckerberg, he can control the kids' brains and create all these these metaverse products and his cool toys. Whereas Baidu, I mean, they're gonna be just left behind. So you can't actually compete without a healthy capital markets, and the sooner they figure it out again in China, the better for them. And that's why I kind of feel like you have to watch this HSI 15,000 level going forward. if that line breaks, then forget everything. Like, just forget it. It's gone.
Well, do you feel if the if the Chinese market does drop through that level, is there possible contagion that it flows into U.S. markets and there's enough fear on the streets where?
I think that's when you have to sell all your commodity stocks as well. I don't think Nvidia is going to care because no one, Nvidia holders seem to be on a different planet, but or Nasdaq holders, they kind of just buy every dip. But if I think at some point, and this is where I have struggled with myself, is like, at which point does the Chinese stock market going down impact commodity stocks? Because I own some commodity stocks, and for example, if I think at some point I have to just sell them all if I see that China is losing control of the stock market, because I actually believe there is a reflexivity in some way. A stock market should indicate the health of the economy, and although I don't think they and it's a question of confidence as well, and it should be reflective of how they're doing. So at some point, if the stock market collapses further, I think it's going to impact the mining stocks, and commodities.
Well, what about the general U.S. markets? I mean, if you say that the U.S. stock market is supposed to be reflective of the health of the U.S. economy, I mean, I think we're seeing a lot of bifurcation here as we've come down from those recent new all-time highs, and we're kind of waiting here to figure out what traders, investors are going to be. But you can't have a stock market that's really traded on 7 different companies that's keeping everything afloat, while you're also seeing, United States Postal Service lay off people. You're just seeing cracks in the employment sector here. It's just, I just don't think that's fair to say. I think there's a huge bifurcation right now. In normal times, I would agree with you. Normal times, but this isn't the normal time.
Look, I mean, they're not normal times. I mean, look, the U.S. stock market, you can argue, is Tamagotchi driven at this point. It trades on a price to Tamagotchi ratio. It trades on the liquidity. It trades on so many different metrics that it's tough to say what it's trading on. I mean, last year you had like the narrowest market I've ever seen in my lifetime, with 7 stocks, and we only had like the rally only for me was actually only the last quarter. The first 3 quarters, it was literally 7 stocks. So it's a tough one. But I think the way I see it, though, is not a question of actual performance. It's a question that I'll probably want to be the first one out of the mining stocks. If I see China continuing to collapse the stock market, I want to be the first one out. And I will be the first one out. Like, I'm not going to have any inhibitions about it. Because I think the way the financial market works is also very spastic in some way. Spastic in a way that, it's headline driven. So you're going to see, oh, China's stock market is going down. It means their economy is doing badly. And there's going to be 100 pods at Millennium and Point 72 saying, oh, you know what? Short copper, short BHP, short Rio. And you don't want to be long when they're coming out after you. So that's what I mean from a trader perspective. If you see that going down, you kind of want to be out of the way. That's what I mean. Yeah. And then you kind of want to just sit back and wait for, the stability, which could come in H2, by the way. But, it's tough to time at this point, because I think at this point, what's happening is they're actually trying actively to stabilize it. Like you saw the first panic, and, when policymakers panic, the markets kind of stop panicking. So I think now we're trying to find a floor. And I have a theory, by the way, that I'll share with you for the first time here. It's a world's first, Shrub's theory of Chinese buybacks. So my theory is this. Here's one way that they can they can arrest the defaults. So they stopped they banned short sales from for certain things. But then one thing they can do to encourage their capital markets and lift their stocks up, a lot of these companies are sitting on a big piles of cash. Like, Baidu, if I recall, they have it's a 40 billion company. They have 15 billion of net cash. I think Alibaba as well, I think it's like a third of its market cap is cash. I can't remember the exact number. But, if the Chinese want my advice, which is not worth much, my theory of buybacks is that the way you support the stock market, yeah, exactly. Tamagotchi Shrub, I'll do it. But they should just get these companies to buy back stock and encourage them to do so. And that's my theory. I think they should tell them, you know what, guys, if they don't believe us that we turn capitalist or that we want to support our market, just buy back your shares. Like do what the Americans are doing. And when they do that, trust me, because if they're trading at 30% discount, 30% net cash, if they allocate cash to buy back their shares, I mean, it's value accretive. I mean, these companies are pretty cheap. Alibaba is trading at like 4 times EBITDA. That's like the multiple that a mining stock trades. Actually, let me see where Rio is trading. So Rio is trading at 5 times.
Yeah.
So there's a lot of value, but they have to crystallize it.
Absolutely. I do want to.
That's why my theory of buyback. Yeah, go ahead.
Well, I want to get this last question in for you, because we've spent a lot of time talking about commodities in China, but I do want to ask you, can I get some thoughts on how you're approaching or watching this New York Community Bank Corp fiasco? It was down shares were down 44% earlier this week when basically they slashed their dividend and stockpile reserves and just, it was a terrible day for them. They also were one of the banks that took some of those assets off the troubled Citizens Bank. And this is all coming back with troubles in commercial real estate, in the bond market and where rates were. We thought we were out of regional banking crisis, but here we are. It seems like it's poking its ugly head back again. Is this just anecdotal, or is this something that we really need to be watching here in the coming weeks?
I think you really need to be watching it, but I'll just clarify it in some way. So I think part of what happened with NYCB is there's part of it idiosyncratic, and there's part of it that merits more discussion. So the idiosyncratic part is they took a capital hit because they bought assets from Signature Bank, so they became a bigger bank. So they transitioned into
I said Citizens. It was Signature.
Yeah,
thank you.
Don't worry, I mixed up the SVB and Signature. So they transitioned to a higher category bank. So they took a hit by having to build reserves to the level of their peers, of their new peers. So that was the idiosyncratic part. But on the more important part for me is that they took losses from 2 specific loans. One was a CRE loan, and the other one was a multifamily residential loan. Now, I think yesterday people were like, "Oh, you know what? That's just a one-off." But I'm actually short one multifamily residential lender where they report monthly data for their delinquencies, and their delinquencies went up like to 25% of their loan book in the last couple of months.
Wow.
So you're talking about some of these, and I mean, if you look at their detail of some of these, what happened basically? A lot of excess took place when rates were low. And this excess has gone obviously to the financial markets, but a lot of some small players just went over the line. So so a lot of people, I think, when they saw New York NYCB yesterday, the bank, they were like, "Oh, you know what? It's a one-off." But actually today in Asia, Alzora Bank, it went down 20%, and because they took a hit on their U.S. commercial real estate exposure. So that's a Japanese bank. So seeing a Japanese bank take a 20% drop because of US commercial real estate reminded me of the German banks that were taking hits in 2008 from their US subprime real estate. And then speaking of German banks, Deutsche Bank took a big hit today. They, of course, it's always Deutsche Bank. They took they increased their provisions in their US CRA commercial real estate portfolio by 4 times. So basically, what's happening is last year we were talking about these trillions in commercial real estate loans, and then a year passed and not many losses were taken, and everyone forgot about them. But actually, it's not going to be a few trillion, but there's definitely losses in the system that haven't been crystallized yet. So this Japanese bank, for example, in November, they said that they don't have to take any more provisions. And fast forward 2 months later, they marked down their New York and I think Texas, if I'm not mistaken, portfolios by 50 to 60%. And this particular multifamily residential lender I'm short, like I said, the delinquencies just jumped over the last 2 months. So what I'm saying is, I don't think we should be panicking about, Bank of America is insolvent or JP Morgan is insolvent. That's not what we're saying here. I think, those are strong banks, and that's not the point. The point is that there's going to be all these small players that had X's in the system, that they did some stupid things when rates were low, and they're going to pay for it, which is kind of what happened with SVB and Signature last year. Well, the same thing is going to happen this year with the ones that took bad loans and or just lax loans in various places like US CRE and US multifamily. And incidentally, by the way, the Fed, when the Fed had their meeting yesterday and they issued their Fed statement, I thought one interesting point was, they issued their original press release and the previous month press release, and they show what changed between the two statements, between the previous statement and the current statement. And one of the things that changed, there's a line that says the U.S. banking system is sound and resilient. Well, it was crossed out on this one.
Yeah, you tweeted that. I think.
But because it was because it was a whole paragraph, I think they just crossed out the whole paragraph to just show that it's just the whole paragraph. It's not this sentence. It's the whole paragraph. So just don't read anything into it.
Oh my God. Oh my jeez. All right.
So yeah, I think it's going to be something to be watching.
Yeah, I think so too. I don't think we're done hearing the news. In fact, we could wake up tomorrow morning when this airs and we could find a bank or something somewhere around the globe that was highly leveraged to commercial real estate, and they're in the sink. So, Shrub, my man, thanks so much for your time. I know it's late for you, but I'm really
Trevor.
grateful. Really grateful. And you can follow Shrub at the X or Twitter, whatever you want to call it, at Agnostox with triple X's. And it's a great account. You have to follow it if you haven't. Thanks, Shrub. We'll talk to you again soon.
Thanks, Trevor. Enjoyed it. Take care, mate.